Okay, let's dive right in. We're looking at this really strange situation from 2023. You had sustainable funds, right? And they saw record net outflows, money leaving.
Over $13 billion, yeah. A huge number.
But, and this is the paradox, the total assets under management in that same sector, they actually grew to 6.5 trillion. How does that even work?
It seems completely contradictory on the surface. It really does. But the key piece here comes from recognizing how ESG factors are evolving. They aren't just these long-term ethical considerations anymore.
Okay.
Well, the Farhadi and Hare research we're digging into today really confirms this. It established that specifically environmental and social risks, they have a moderate, but definitely significant predictive relationship with short-term stock price moves.
So ESG risk is becoming a dynamic signal, like something traders can actually use.
Exactly. It's moved beyond just a values thing into active financial signaling.
So the big question for us then is how? How do these E&S risks specifically drive that short-term market momentum? And the corrections, the speculation that maybe led to those outflows?
Well, it challenges that old idea, the efficient market hypothesis, the one that says all information is instantly baked into the price.
Right, EMH.
This study, which looked at large cap S&P 500 stocks between 2022 and 2023, it found that ESG risk often isn't priced in efficiently, at least not immediately.
Okay, so there's a delay, a mispricing.
A temporary mispricing, yes. And that gap creates the potential for, well, short-term opportunities. Or problems, depending on how you look at it.
Okay, so if the risk isn't immediately factored in, what's the actual mechanism they found? How does that delayed pricing cause volatility? Is it just random noise or specifically ESG driven?
Good question. They looked at market momentum using the relative strength index, the RSI.
RSI, okay. Standard momentum indicator.
Right. And here's the really fascinating part. They found that increased environmental risk and increased social risk, they were positively associated with higher average RSI readings.
Wait, higher risk meant higher RSI. Higher RSI usually means overbought, right? Speculative frenzy.
Precisely. Higher E&S risk correlated with the market conditions we'd call overbought, indicating speculative buying.
Hold on. That feels backwards. Why would speculators pile into riskier sustainable assets? You'd think they'd avoid them.
Well, it seems they're chasing a perceived premium. It's created by that information gap, that delay we talked about. Because the risk isn't instantly priced in, speculators might see an opportunity, jump in, and artificially inflate the price, pushing it into overvaluation territory.
Okay, that starts to make sense. The rapid buying creates the overbought condition.
Exactly. And that speculative bubble built on delayed risk recognition creates the perfect setup for an inevitable market correction.
So that could explain 2023, that $13 billion outflow. Maybe it wasn't people giving up on sustainable investing entirely.
It suggests it was more of a direct, measurable market reaction, a correction hitting those specific overvalued high E&S risk securities.
Not a wholesale rejection of ESG.
The data points that way. And interestingly, the study found governance risk, the G in ESG, was statistically insignificant here. It didn't seem to predict these short-term moves.
So it was all E&S.
The predictive power was concentrated in the environmental and social factors for these short-term dynamics.
That's a crucial nuance. And it connects to this other big confusion point in the market, doesn't it? The ESG data paradox.
Yeah.
Why one rating says good and another says bad.
Absolutely. And the research helps clarify this by highlighting the difference between ESG risk and ESG performance. They're not the same thing at all.
Okay, explain that distinction.
So the study mainly used Sustainalytics data, which focuses on ESG risk. That's about a company's vulnerability to material ESG issues. And like we said, higher risks seem to drive that short-term speculative momentum, that high RSI.
Right. Risk equals momentum, paradoxically. So what about performance? Like how well a company's actually doing on sustainability?
Great question. When they switched and used Refinitiv data, which measures ESG performance, actual achievement of goals, the relationship flipped. It was negative.
Negative correlation. So high performance meant lower short-term momentum.
That's what the data suggested. It implies these high-performing companies might already be fully valued, or perhaps they're held by more long-term investors who aren't driving that speculative froth.
That distinction is massive for you, the listener. It means the ESG data you choose has to match your strategy. Are you looking for short-term momentum signals using risk data? or long-term value using performance data. You've got it. It's about aligning your data with your investment horizon and goals.
So bringing it all together, what's the practical takeaway here? The research really nails down that ESG risks are financially material, right? They're not just nice to haves. Definitely material. They need to be part of serious risk management. And as we've discussed, maybe even used tactically for what you could call ESG momentum strategies.
ESG momentum, wow.
And stepping back to the bigger picture, think about what this implies. The core finding is that data inconsistency, information asymmetry leads directly to market mispricing and volatility.
Which makes the case
for standardization. It strongly reinforces the urgent need for clearer, standardized, and more frequent ESG disclosure, like what the SEC is pushing for with its 2024 climate rules.
So the final thought is, this new wave of transparency, it's not just about compliance.
Not at all. It's likely going to fundamentally change the game. Those short-term information advantages, the mispricings based on patchy data that drove this whole phenomenon, they could start to disappear, transforming how markets analyze and trade ESG.